listed SPACs, and 104 have announced but unconsummated transactions. Last year at this conference, I reported that I had seen a Bain report that indicated that there were 29,000 companies sitting in private equity portfolios for more than 7 years. A month ago, I saw that figure had ballooned to 35,000. Add to that universe a new possible business combination targets of all the private credit deals that may have difficulties as well, of all the other domestic and ex-US operating businesses frustrated by or excluded from the traditional IPO process. Even with all those potential targets, very few of the closed or announced de-SPAC transactions have actually been sourced from those same private equity portfolios. So that means there's a lot of still hunting to do. So for the SPAC market to really absorb all the current listings, hopefully those PE sellers will become more receptive to this community and consider a de-SPAC transaction. Despite the narrative that today's market is in sharp contrast to the early 2020s, there are still plenty of highly speculative pre-revenue proposed transactions. But today's market also rewards proposed business combinations with tangible fundamentals, business-to-business revenue, and strategic geographic positioning. Recent core themes that are dominating announced proposed transactions include critical infrastructure and energy, frontier hardware and technology, logistics and reshoring, fintech and infrastructure. Those de-SPAC transactions that managed to secure a $100 million common equity pipe prior to publicly announcing a target trade on average above $12.50 at the business combination closing. That is a higher trading cohort than any other proposed business combination transaction. Even if a proposed de-SPAC doesn't include $100 million financing, deals with any institutionally qualifying pipe capital trade significantly better than those without one. Please keep in mind that last year's one-time crypto treasury phenomena might distort those statistics. When we look at business combination trading for those deals closed last year and thus far in 2026, the results continue to be a mixed bag. Out of the nearly 50 consummated transactions in the last couple of years, there are only 10 trading above trusts. I would suggest, however, that while that headline is sobering, the results are still not actually in. Since many of the now public operating entities are truly early stage, they will need several more years to demonstrate viability. If there's one risk that I would highlight to this audience more than any other, it is underfunding. Closing a transaction with less than 1 year of runway or without a pathway to relieve pressure on an over-leveraged balance sheet while a perfectly legitimate use of a de-SPAC vehicle, assuming proper disclosure, it is commercially very risky if you can't achieve cash flow neutrality in the short term or raise capital quickly. Since we can readily acknowledge that many of the universe of target candidates are typically earlier in development than traditional IPO companies, it also stands to reason that they will need more time to properly implement their business objectives and build a viable company. So while the daily stock price must be used as a key metric of success, the operations realistically take years to actually establish, like with the private venture market. Unlike many commentators and journalists, though, I don't see this as a knock on the industry. It allows true public investors access to venture capital opportunities sooner than otherwise available in the private markets. It's inconsistent for politicians, investor advocates, and academics to be critical that many of today's traditional IPO companies remain private for too long, thereby depriving the public of access to good emerging growth investments, and then not fully support what we are doing as an industry with SPACs to provide exposure to the public markets of emerging companies. In my view, one has to have a consistent public policy that the public markets are not, sorry, this is poorly written. Let me read it slowly so I can get the meaning across. In my view, one has to have a consistent public policy It's still not going to be good. The public markets are only for trillion-dollar Silicon Valley tech firms with confirmed and viable businesses, or should they accommodate for venture emerging opportunities as well? The point being, we want to encourage private companies to go public through SPACs to have more venture opportunities available for both institutional investors as well as the public. By design, the Securities Act of 1933, implemented and enacted by Congress, was of the view that so long as there is full and fair disclosure, even riskier emerging market companies should be able to avail themselves of the public markets in the United States. After the SEC's overhaul of the SPAC rules a few years back, there simply can't be a current argument that this industry doesn't adhere to the highest standards of disclosure. This has actually been true throughout the 25 years of the SPAC history, notwithstanding some specious suggestions to the contrary. But now, after the new rules, even that argument is presumably put to rest. This is by no means to suggest that there isn't a significant financial risk associated with investing in de-SPAC transactions. Retail investors must fully be so advised. The data for this most recent cohort of deals indicates that 18 of those same 50 deals referenced earlier are trading down 80% or more, and the balance are underwater from the $10 offering price. Investors need to appreciate the commensurate risk attendant to these types of deals and the specific risk of underfunding in particular. I do believe that sponsors, boards, bankers, and other professionals should seek to ensure that enough unrestricted capital is being raised to fund operations for at least a year post-closing, and that equally clear risk factors are disclosed if that hasn't been secured. Other companies, such as those transitioning to A1 infrastructure and hosting services, may need to secure vast sums to execute their business plans, and those with leveraged operating business need to get buy-in from private credit sources early in a deal process to positioning themselves for increased likelihood of long-term stability. I think it makes sense, though, to take a minute to reflect on those transactions that have received early recognition and traded above trust in their debuts. The top performers are, and congratulations to all of them, Luke Wheel's Willow Lane Boost Run, which is having the best performance so far, is trading at $28 or $29 last I looked, riding the AI cloud and infrastructure, and congratulations to BIG who banked that deal. To Haymaker Sunscrete, which is $17, a ready-mix concrete logistics and distribution platform, Baird banked that deal. DMY Squared, Horizon trading at 11. It's a software infrastructure for quantum application deal. Needham banked that deal. EQV Presidio, $12.25, oil and gas operator. Cohen Circle Kyivstar, the leading Ukrainian digital operator. Cohen and Rothschild. Inflection Point, U.S. Rare Earth, trading at $22.50, a domestic critical metals and permanent magnet company. Cohen banked that deal. Spring Valley Eagle Nuclear, trading at near 10, holding the rights to the largest uranium deposits in the United States. Cohen banked that deal. When you widen out the aperture further, over the last 7 years, approximately 25% of all de-SPAC transactions continue to trade on a Russell index, and 78 of those same cohort have been acquired. Interestingly, over that same period of time, 2 times as many unprofitable companies have been targets, and recently they have traded better on the whole than profitable targets. Thanks to Andrew Mahler for those stats. And Crocker Colson, who actually did an interesting piece the other day. You should look that up. All in all, though, we are in a market where the current regulators, for the most part, are like professional sports referees in playoff games. They are just letting the players play, and the results will speak for themselves, for good or for bad. Unlike last night's or the other night's game, where the referees only let one team do what they wanted and called a much tighter game on the New York Knicks. Similarly, the prior SEC administration sought to inappropriately interfere in the SPAC market with new rules designed to frustrate rather than improve our market, favoring reinterpretation of time-honored conventions and opportunistic enforcement against those it sought to make examples of, We are, by contrast, currently experiencing a regulatory laissez-faire environment for the most part. We do still experience pockets of inconsistency amongst agency and stock exchanges with respect to their review processes, particularly the exchange listing application process. SPAC IPOs, since the government shutdown last year, are more often than not getting no reviews. De-SPACs are also receiving reasonable reviews of file disclosure documents without an I gotcha attitude. SPAC business combinations are now getting similar review treatments to other types of financing submissions, finally honoring the former chairman's quotation of Aristotle that we shall treat like things alike. This new SEC administration must also be credited for the new and compelling approach they have proposed to implement many new rules to streamline securities regulations in general, as evidenced, for example, by new proposed rules that, if adopted, would impact how many public issuers can use an S-3 registration statement, which I understood was a topic of conversation yesterday. Included in the new proposed shelf eligibility guidelines, an exemption that would also permit qualifying recently de-SPAC public issuers that are not foreign private issuers to issue a shelf registration without delays or restrictions associated with the SPAC prior shell status. This is an enormous departure from the SEC's prior views on which public issuers may afford themselves of this more flexible registration statement. The fact that SPACs have been included for favorable treatment is unusually enlightening and true credit to the new SEC approach under the administration. For me, this is very relieving, but it makes for much less interesting speeches because I love to attack regulators that are picking on the SEC, on SPACs. For some very odd reason, though, we aren't seeing equally enlightened regulation out of NASDAQ. With seemingly no real pressure from the SEC, why NASDAQ would choose this time to weaponize their newly acquired discretionary authority to decline a listing is a bit befuddling. For those of you who may not know, NASDAQ petitioned the SEC for and received approval for NASDAQ Rule 5101. This rule grants NASDAQ broad discretionary authority to deny, condition, or suspend the listing of any security for any reason without explanation. In parenting circles, this is known as the "because we said so" rule. In theory, it was granted to ensure market integrity, prevent manipulative practices, and protect investors. In practice, it means NASDAQ can enforce listing criteria and block a company even if that company meets every single qualitative and quantitative metric on paper. The applicant can satisfy the four-corner test of all their rules, but if for some unknown reason they don't like the country of origin, members of the board, large shareholders, the industry, who your professionals are, you will be denied a listing. If that isn't bad enough, and here's the zinger, 5101 gives NASDAQ a 10-day review period. As we have witnessed firsthand, there are some at NASDAQ that interpret the adopting release to grant the listing authority to begin that review process after NASDAQ has otherwise notified the applicant of its clearance. If you think you didn't hear that correctly, let me repeat it. Certain examiners believe that they can grant you an official clearance and then subsequently subject you to a 5101 review. So after you've been notified and are preparing for closing, making plans to fly in for the closing of the transaction and getting excited to ring the Times Square bell, they have scheduled for you. They alert counsel that they may implement the 10-day review period for subject to review. How completely commercially nuts is this interpretation? In the case of a de-SPAC client's deal closing a few weeks ago, we had just this circumstance. Ultimately, after appealing to more senior officials, the 5101 review waiting period was reversed and the deal closed. We've since reached out to NASDAQ to officially confirm that this interpretation won't be implemented again, but have not received any assurances so far. Now I've done my job and you have been forewarned. Before closing my remarks, it's worth also noting that aggregate redemption rates, while they do remain quite high, frequently in the 90 to 95% range, There is also good news for well-received, fundamentally sound deals. We have recently seen selected deals closing with zero or near zero redemptions. This is a big change from a year and a half ago. Like in other SPAC cycles, the playbook for a well-received proposed business combination really hasn't changed that much. The data indicates that if a sponsor and target want to de-risk a transaction and optimize for the best outcome, the absolute best approach continues to be marketing and securing an institutional $10 equity pipe prior to announcing the business combination. Also, while I have regularly reported at this conference on the unfavorable SPAC decisions by the Delaware Chancery Court since Multiplan in 2022, it is important to note that the same court dismissed in 2024 the claims brought in Hennessy Capital, setting a firm defense win. Vice Chancellor Will granted the motion to dismiss, confirming that even under entire fairness scrutiny, plaintiffs must plead specific knowable omissions. So while the industry continues to organize an overwhelmingly majority of SPACs in Cayman, largely due to the redemption-related tax exposure, Delaware case law continued to evolve with a better understanding of the SPAC industry. I mention this not because SPACs are going to organize in the United States until the outright elimination of the redemption exercise tax, but because many Cayman SPACs will conduct business combinations that will become subject to the Delaware courts, and we believe all such transactions should be processed with this in mind and to the same standard that the Chancery Court has indicated, leading to the favorable ruling in Hennessy with the motion to dismiss. Also of note, and thanks to Yelena for publishing this, in View Operating Corporation v. Starstone, the Delaware Superior Court ruled that the D&O policy's public offering exclusion did not preclude coverage for claims arising from a de-SPAC merger. The court also found that the insurer had to fund a former officer's defense costs. What I'm getting at is just because you do a deal in Cayman doesn't mean it's not going to be subject to the Delaware courts. So apply the Delaware standard of processing for best practices. Before I let you go and the conference moves on to the panel discussions, I do want to pause and acknowledge the 25 years of building the EGS SPAC practice with my partner, Stu Neuhauser, who many of you largely know through short cryptic texts reflecting encyclopedic knowledge of the SPAC business and its innumerable issues. If there was ever an argument for flat fees and the efficiencies that it creates, look no further than his communication skills. Long enough to answer your questions and short enough to question how it is possible he knows that answer so quickly and without research. Stu, you are an invaluable resource to the entire EGS ecosystem. Thank you very much.